Turning now to the U.S. economy, Jason Schenker joins me. He's chairman of the Futurist Institute, president of Prestige Economics. Jason, good to have you.
Great to be here today.
All right, so the inflation data behind this headline figure of 2.7% today is incomplete because of the shutdown. Do we therefore have an inaccurate picture of where prices are actually headed in this country?
Well, I think we have a rough idea of where we are. We do see that inflationary levels are still above the Fed's 2% target. That's clear. But the year-on-year rates have eased. Part of the reason we don't have month-on-month for November is we didn't have the October data because of the shutdown. So you can't gauge the month-on-month. But we do have an underlying price index, which tells us what the year-on-year rates are. And so we know we're a little bit elevated. We also know that the 2.7% year-on-year headline number and the 2.6% year-on-year core are slower than the 3% readings for both of those series that we had for the month of September. We also know that services are still the big problem. If we look at year-on-year core services, so services excluding energy services, that's up 3%. But core goods, which excludes food and energy, that's the stuff that tariffs would impact, that's up only 1.4% year on year. So writ large, inflation is still elevated, but it's a little bit slower, and services are still the biggest thing to blame.
Some economists, including Mohamed El-Arian, noted that in this data, the housing portion was particularly suspect. And as you know, housing prices are one of the biggest pressures on rising prices in this country and a big portion of most people's monthly spending. Is that problematic, right? I mean, do you share the view that actually when they take another look at these numbers, the inflation rate will be higher?
These numbers can be subject to revision. That is true. But the housing components, the shelter component, that's part of those core services. And of course, housing 60%, it's about services are over 60% of the CPI in general. And the shelter component is a big chunk of that. I think it's 30 to 40% of the total level of inflation are in the shelter piece. But this is something that would show up in that core services number that's up 3% year on year. In the most recent data prior to this, the September report, core services were up 3.5%. So there has been a significant slowing, but 3% year on year for those core services is still an elevated inflation number. We don't know fully what the data picture might be as we get more data, a more complete picture. The same thing's true with the jobs numbers, where as we get a more data in, we will have a more complete picture. But I don't think it's inaccurate to say that we do see still elevated inflation rates and services do seem to be the cause.
Well, what's your best assessment of the overall state of the economy? Because inflation is down from that 9% rate, but 3% is, as you note, above the Fed's target. And income, wages, largely based on CNN's own analysis, not keeping pace, and job growth has been as slow. I mean, the last time we saw it this slow was back in 2020. I mean, what does that tell you as an economist about the overall state of the economy?
We're seeing a couple of different things at the same time. One is the unemployment rate has gone up significantly over the last 2 years, with the unemployment rate of 4.6% and rising. That's a risk. Plus, we know that recent college graduates ages 22 to 27, their unemployment rate's even higher. I believe that's around 5.8%, according to the New York Fed's latest report for the most recent quarter. So that tells us that there are some issues in labor force. But if we look at jobless claims are pretty low, still around 1.9 million jobless claims, at the same time that the October JOLTS data showed there were almost 7.7 million open jobs. So it's kind of a mixed bag, right? The payrolls, by the way, for most of the last 2 years have been positive monthly gains, but the number of new jobs added isn't keeping pace with the number of people coming into the labor force. So we see payrolls have slowed. Job gains are not sufficient to prevent unemployment from rising, but we still have a lot of open jobs. The problem is where the open jobs are is not necessarily where the new labor market entrants are. Those recent college graduates may not be looking to fill those jobs that are in healthcare, almost 1.4 million, or construction, or 200,000 or so, manufacturing 400,000, warehousing, transport, utilities 400,000. So you see that where the jobs are and where the workers are, there's kind of a mismatch at the moment, and the Fed is under real pressure because payrolls have slowed, they haven't collapsed, but the unemployment rate is the highest in September of 2021.
It's quite a
GDP, though, still looks good. The Atlanta Fed GDP now looks like Q3 GDP might be 3.5% based on the available data through December 16th. So it's a really mixed outlook, and it's murky for the Fed.
Yeah, it's hard for people to follow. Jason Schenker, thanks so much for joining.